So good morning, everyone. You're welcome to our revision class, our intensive class. And today we'll be focused on solving few more accounting standards. Then I would want to solve some questions on statement of cash flows. My focus today really is consolidated statement of cash flows, just so that you understand it in case it becomes your number one in the exam. So I want you to be abreast of this. So if we achieve that today, that's my plan for today. Hopefully we're able to achieve it. Then we'll move on to other areas the next time we are meeting. And the other areas is just to solve more questions on accounting standards and those theory part, and also to solve more questions on group accounts, some other areas. So then we'll be done for the intensive class. So let's focus on what we have for today. So I'll be starting with this question. We're using a past question approach. So from there, we're going to spread our tentacles. So this also is from May 2025 diet. And it says, if you look at the requirement of the question, it says you should discuss briefly three types of share-based payment transactions recognized under IFRS 2. So this is a discussion question. And if you look at it, it's 3 marks. So what I will just do is just to use this question to teach you about share-based payment, to remind you about share-based payment. So the length of my solution might not be the length of your solution in the exam. However, if you can pick the important points, that's what you're expected to tell the examiner when you get to the exam, or in case they ask a question on share-based payment. So the question says share-based payment occurs when an entity purchases goods or services from another party, such as a supplier or employee, and rather than pay directly in cash, the transactions are settled by issuing shares, share options, or future cash amounts linked to the value of the shares. Before the publication of IFRS 2, share-based payments, they appeared to be an anomaly, to the extent that if a company pays its employee in cash, an expense is recognized in the statement of profit or loss. But if the payment is in share options, no expense is recognized. So, this question is a clear description of what share-based payment is all about. He has explained the core principle behind share-based payment. Because share-based payment is a form of payment also, where an entity settles goods or services in shares or share options or future cash amounts linked to value of shares. Imagine you're a company, and maybe if somebody walks into your store, the person happens to be the MD of a bank, and he says he wants to buy 10 bags from you. And he says, okay, instead of giving you money, he says he's going to give you the shares of that bank. Now, the focus of share-based payment is not about you, the seller. We are not concerned about you that is selling or you, the provider of service. That's not whom the focus is. The focus is on the person that is paying, on the person that is enjoying the service. Because you, the seller, you're going to recognize revenue either ways. IFRS 15 takes care of you. But now we are talking about the buyer. How will you recognize that transaction in his books? Because he's not paying money, he's giving you shares. And that's the focus of IFRS 2 on share-based payment. And typically, besides the example I've given you, share-based payment transaction is common for transactions between employer and employee, where employer will promise to give its employees shares in future, which they call share option, that if they're able to achieve certain level of performance, they will give them shares. So like this paragraph 2 of this question is talking about, that they don't account for such transactions because they believe that like it doesn't have substance. That should be, we are not paying now and we have not given them the shares yet. So there is nothing to account for. And that's wrong. And that's what IFRS 2 came to clarify. That because you are paying in shares doesn't mean it's not substantial, doesn't mean there's no substance, or because you have not issued the shares now, that does not mean that the transaction does not exist now. It exists right from the date of the agreement. So IFRS 2 talks about three types of it. There is the equity settled share-based payment transaction. There is the cash settled share-based payment transaction. And there is the equity or cash settled share-based payment transactions. So for the equity settled share-based payments transaction, these are the transactions whereby an entity receives goods or services from a supplier or its employees and settles by issuing shares or share option to the supplier or employee. That's equity settled. You receive goods, then instead of settling with cash, you settle with your shares or share options. And I know you know the difference between shares or share options. Shares is you're giving the shares is immediately. When you're issuing shares, it means you're giving the person shares immediately. The person immediately becomes your shareholder. But if it's share option is a promise to give shares, meaning you are not giving the shares now, but you're going to give the shares in the future, most likely when the counterparty meets certain conditions. That is when you're going to give the shares to the counterparty, that is your employee or a supplier. But that's equity settled. So the key characteristics of equity settled is that the entity usually gives what they grant. Instead of money, instead of cash, they give shares, share options, or any other equity instrument. But the common one are shares and share options. But the one you find often in your exam is share options. Another key characteristic is that they don't pay in cash. No cash consideration. That the consideration is just equity instrument that is issued. And also, the shares that is given or the transaction is measured at the fair value of the goods or services received. But in a transaction with an employee, it's not possible to determine the value of the goods or the services that the employee is providing.
is difficult to do that. So in such cases, you would measure the transaction at the fair value of the equity instrument granted. And the way it is recognized in the books is that you recognize the value in P&L, and the other leg will go to equity. That's how we recognize it in the books, P&L and equity. And the key examples are granting share options to employees as part of their remuneration package, or issuing shares to a supplier in exchange for consulting service, or employee share options, share purchase plans when shares are offered at a discount. This is the one you will find in your exam often. This is the one they always ask you. And that's a major example I need our eyes to be focused on, where an employer grants share options to an employee as part of the remuneration, as part of the remuneration package. And that's the first type of share options: equity settled share-based payment. That's the first type of share-based payment transactions. The second type is cash settled share-based payments. For this one, the entity receives goods or services from its employee or supplier, and in return, the entity incurs a liability because he has to pay cash, in this case, to the counterparty. But what is special about this is that the cash is linked to the value of entity's shares. The cash is linked to the value of its shares. So this one has a distinct feature in the sense that the entity is still paying cash, not now, but in the future. And the value of the cash is based on the entity's shares. So for cash settled share-based payment, there is no shares or options here. The company is not issuing shares or options. But what will happen is that they will pay cash. Also, here, because the company or the entity is paying cash, they have a liability. When you have an obligation to deliver cash, that is a liability. And that liability is measured at the fair value of the liability. That liability is measured at the fair value. And at the end of each year, you continue to remeasure that liability. And at settlement dates, the liability is extinguished by cash payment when you settle up. And a typical example of this are share appreciation rights, where employees receive cash equal to the increase in share price over a specified period. This is the popular one you are going to find in your exam. That's the one you should focus on. Share appreciation right, where employees receive cash equal to increase in the share price over a specified period of time. And the third one is transaction with a choice of settlement, which is cash or equity. And in this transaction, the entity receives goods or services, and either the entity or the counterparty or the two of them, they have a choice as to whether the transaction is settled in cash or by issuing equity instrument. So that's a choice of settlement. So for this one, the company or the entity that is receiving the goods, either of them or the counterparty, they have a choice whether the transaction is settled in cash or by issuing shares. So it's either of the two. So the major feature here is that the transaction may be settled in cash or shares or share options. And how you classify it depends on who is making the choice. If it is the entity that is making the choice and has a present obligation to pay cash, then you are going to treat the transaction as cash settled. That's cash settled. Because cash settled is where you are paying cash or when you will pay cash for the goods you received. So what you recognize is a liability. But if it is the counterparty, that is the employee or the supplier that has the choice, then in this case, it becomes a compound instrument that we have to separate into liability and equity. Because at that point, if it's the counterparty that has the choice, the entity therefore does not know whether the counterparty would opt for cash receipts or shares. We don't know. So we treat it similar to how we treat compound financial instrument. I taught you that last weekend. So you will then measure each component part appropriately. So we'll measure the liability at fair value, which will be remeasured every year, and the equity at fair value at the grant date, which this one is not remeasured. So equity is equity. The value does not change, just like what I taught you. So a typical example is an employee that is granted a bonus that can either be taken in cash or shares. Or a supplier that is given an option to invoice either in cash or a fixed number of shares. That's transaction with a choice of settlement. So these are the three types of share-based payments transaction. So we'll solve a question to see how it works. And when we solve more questions, when we see it in past questions again, you'll be able to at least know the types of share-based payment. Any questions? Okay, so the B part of this question talks about, it asks us to calculate the expense and liability that will be shown in the financial statement of Adimula PLC for all relevant years. For all relevant years. So, expense and liability. Now, in this case, it says that Adimula PLC is a company established by a group of IT experts based in Lagos with offices in various computer villages across the 6 geopolitical zones in the country. The company has a special development program for its young employees,
which involves sending them to Japan on a regular basis to acquire knowledge on AI as well as IoT. However, because of shortage of IT experts and with specialization in AI in the country, the multinational companies operating in Nigeria frequently poaches the staff of Adimola PLC after they had been trained by the company. The board of directors of Adimola PLC decided to introduce a staff incentive scheme to prevent losing employees to the multinational companies. In view of this, Adimola PLC granted 100 cash share appreciation rights to each of its 500 employees. Each grant is conditional upon the employee working for Adimola PLC over the next 3 years. Further information available about the SAR as follows. We're given the actual employees leaving the company in the year. We're given estimate of further employees that may leave in the future. We're also given number of employees whose interest is expected to vest and actually be vested. So we're given for 2019, 2020, 2000 and 2021. We're then told that Adimola PLC estimates the fair value of the SCR at the end of each year, in which liability exists, as shown below. So we're given the fair value for 2019, 2020, and 2021. Okay, and that's the question. So, all in all, the major part of this question is the fact that the company is giving share appreciation rights to its 500 employees. And the condition is that they must work for the company for the next 2 years. So the first thing, when you have a question like this, where employer is giving share-based payments to employees, you need to identify whether this is equity settled or cash settled or where there is a choice of settlements. Okay, so in this case now, what do we have? Can anyone spot it? Is this equity settled or cash settled or where there is a choice of settlement? Can you spot what it is?
Cash flow.
Yes, this is cash settled. And that's because what Adimola PLC is granting is a share appreciation right. Okay, and that's why it is a cash settled. It's cash appreciation right. And if you look at the summary I gave you up there, you'll see that for cash acquisition rights, the company will give cash to the employees in the future based on the value of their share price. Based on the value of their share price. So because of that, what the company will recognize is a liability. And that's why what the question is asking you to do is that you should calculate expense and liability that will be shown in the financial statement for all the relevant years. So let's do that. In 2019, so we are giving 100 share acquisition right to each of our employees. Okay, so 100 share acquisition right. How many employees do we have? We have 500 employees. But what we need, the number of employees we need are the number of employees that we will actually give these things to. Is the estimate of the number of employees that will vest. Estimate of the number of employees that, when I say that will vest, I mean that will work for us for 3 years. That is what we recognize in year 1. So they already give us that in this question because this table given to us
They said in 2019 that 35 employees left in 2019. They now estimated that further 60 will leave in the future. So which means in the next 3 years, they're estimating that 95 will leave. So only 405 employees will vest. That's why what we're using here is 405. Those are the ones that we have liability for. Those are the ones that we estimate will not leave or will meet the condition. You multiply it by the fair value of the options of the rights at the end of the year, which is 15 naira. So multiply by 15. If you do the arithmetic, you will get 607,500. So this is the liability that we have to our employee. But since this is the liability for the entire 3 years, this is the value of the liability for the whole 3 years. But the employee has only worked for 1 year as at 2019. So the only liability we have is relating to the first year. And that's why we are multiplying this by 1/3. So 202,500 is now our liability in year 1. And the same goes to P&L. In year 2, which is 2020, we still have 100 share appreciation rights. But now, we're told that in 2020, 40 left this year. And we're estimating that further 25 will leave, which means that in year 1, we know that 35 left actually. In year 2, we now know that 40 left actually, making a total of 75 in year 1 and year 2. Now, they are now estimating that additional 25 will leave next year. So the estimate of total departure is 100. And that's why we have 400 here in the last column. It is only this 400 that will meet the condition. As of now, is an estimate because we are not in the future yet. That's why we are estimating for the future. And we consider that as well. So only 400 employees will meet the condition. And those are the people we are going to, that we have liability for. And that's why we use 400 here. Multiplied by the fair value at the end of 2020, which from the table here, the fair value at the end of 2020 is 18 naira. So as at year 2, the total value of our liability is 720. The total, maybe for the entire 3 years. But since the employees that are vesting, that we estimate will vest, have only spent 2 years with us. So we don't owe the entire 720 yet. We only owe 2/3 of it in year 2. And that's why we multiply by 2/3, which brings our liability from 202,500 up to 480,000. Up to 480,000. So which shows that there is an increase in liability. Which shows that there is an increase in liability. And that increase in liability from 202,500 to 480,000 is what we are going to recognize as an expense. So this is recognized as an expense, which is this minus this. In 2021, we still have 100 share appreciation rights, but now this is the date or the year of vesting. we now know that 22 actually left also in 2021. Of course, they cannot give us any estimate for of people that will live in the future. There's no future again. This is the year where we'll count our losses. So in totality, 35 left in year one, 40 left in year two, 22 left in year three. So the total actual people that have left is 97. And that's why out of 500, that's why we're having 403 here. So we did 100 times 403 times multiplied by the fair value at year three, which is 20. And that gives us 806,000, which is our liability for the 3 years. So that's why we multiply this by 3/3. So as at today, our liability is 806,000. So there is an increase in liability by 326,000, which is this minus 480,000. And that's 326,000. And that goes to P&L as an expense. This I've done is similar to equity settled. It's the same thing. The only difference is that for equity settled, instead of using fair value at the end of each year, we use fair value at grant dates. The fair value of the share options at grant date, while this one used at the end. And for equity settled, instead of taking it to liability, we'll take it to equity reserve. Okay. Any questions?
Good morning, sir.
Good morning.
The question I was going to ask, you have already answered it. That is saying that if it were to be equity, the fair value of the grant date will be used. That is the value there will be used. But if we have more than one or two values there, do we also use it the way we have used the one for share appreciation right?
No. You will still use if it's equity settled. If it's equity settled, you are still going to use the fair value at the grant date of the share option at the grant date. That's what we use for all the years.
Okay.
Yes.
Like the question I also want to ask is what we have just solved now. Assuming we are given just only one value, we can use the value throughout the 3 years.
For which one?
Like what we have just solved now, assuming we have 15, 18, and 20, assuming it is only one value that is given to us for the period, we can use, assuming it's 15,000, that is 15 that is given to us, we can use that 15 throughout.
For cash settled, they cannot give you.
I mean, okay, they cannot give us one particular value.
Yes, for except if the value remains the same for the 3 years, because the accounting is that you value it at the fair value of the rights at each year end. So it depends
Okay.
on what the fair value is at that year end. So if they
Okay,
wanted to do cash settled, they won't give you one value at the beginning. It's not possible.
okay, sir. It's all right, sir. I'm okay, sir.
All right.
Thank you.
Okay. Now, this question, it says discuss how transactions 1 to 3 should be accounted for in the financial statements of the Ramsey Limited. Discuss how the transaction 1 to 3 should be accounted for in the financial statement of the Ramsey Limited for 15 marks. So here now, they want you to discuss these transactions. So how do you go about that? Let's read what the transactions are about. It says the Ramsey is a limited company whose financial statements are prepared using IFRS. The company has the following transactions. Transaction 1 says the Ramsey has outsourced its waste collection to a private sector provider called Urban Waste and Co. and pays an annual amount for its services. Urban Waste and Co. buys vehicles and uses them for the Ramsey waste collection only. The vehicles are painted with the Ramsey Company's Limited's name and colors. The Ramsey can use the vehicles, and the vehicles are used for waste collection for nearly all the assets' life. In the event of Urban Waste and Co.'s business season, the Ramsey can obtain legal title to the vehicle and carry on the waste collection service. Okay, let's do the transaction because they are separate transactions. So can anyone discuss, just tell me, how will the Ramsey account for this transaction now? Look at it.
I would say it's FIRS 16 leases.
You say FIRS? Informa, did you say FIRS or IFRS?
No, IFRS 16, sorry.
Yes, that's correct. So I need you to speak to it. What exactly is going to happen here? Ufoma is right. She knows what the standard is about, but she doesn't know where to start and when to end. So what is happening here is that we outsourced our waste collection to a company called Urban Waste, meaning that they are the one that help us deal with our waste in our company, and we pay them annually for the service. So the guys, Urban Waste, bought a vehicle and they use it for us alone. They use it for us alone. So the vehicles are painted in, they even painted the vehicles in our name. And we can use, meaning when I say we, I mean that I'm saying we can use the asset for all the assets life. And if the Urban Waste, meaning the outsourcing company, if they cease business, we can obtain legal title over the asset. So to answer this question, you just need to talk about that the asset in question, that based on the principle of substance over form, the asset is the asset of, it's owned by Urban, but it's the Ramsey that's using the asset. And according to IFRS 16 on leases, where an entity that is not the owner of the asset has right to control an asset, which means that it obtains substantially all the economic benefit from the assets, and it has the right to direct the use of the asset, then it should recognize the asset in its book. So the Ramsey will recognize this these vehicles in his books, and he will recognize both a right of use asset, because now he's the lessee. He will recognize a right of use asset, and he will also recognize a lease liability. And he will measure the right of use asset at the present value of the unpaid lease rental plus any amount paid at the commencement date plus direct costs, while the lease liability will be measured also at the present value of the unpaid lease rentals. And that's all you need to talk about. For transaction 2, it says Daramsin owns a warehouse which is leased to Agro-Allied Limited, used as a storage facility for pesticide and chemicals. The government has announced its intention to enact legislation requiring property owners to accept liability for environmental pollution. As a result, Daramsin has instructed a hazardous chemical policy, has introduced a hazardous chemical policy, and has begun to apply the policy to his property. Daramsin has received reports that the chemicals from Agro-Allied Limited have contaminated the land surrounding the warehouse. Daramsin has no recourse against Agro-Allied or its insurance companies for the cleanup costs of the pollution. At October 31st, 2021, it has become certain that the draft legislation requiring a cleanup of land already contaminated will be enacted shortly after the end, another 5 months. So how will Daramsin account for such liabilities? So what's happening here is that we have a warehouse that we gave to Agro-Allied as a storage facility. So the guy used to store pesticides and chemical. So the government has announced its intention to enact a legislation that all property owners will accept liability for environmental pollution. Okay, so because of that, the guy introduced a policy and has begun to apply it to his property. So you received reports that his tenant, Agro-Allied, has contaminated the land surrounding the warehouse. So, and they are told here that Daramsin has no recourse against that Agro-Allied and its insurance company. So, and it is now certain at the end that the government will require cleanup. So what's happening here is this. The fact remains that Daramsin has to clean up, and the government has said that you have to clean up, and you will then spend money to clean up. So how do we account for this? What is this talking about? The only way is to account for this in line with IAS 37 on provisions. So he needs to make a provision for that cost. And for you to talk about this, the first thing to talk about is the principle, because they ask you to discuss. So you need to tell us the criteria or the recognition criteria for provision. That's the first thing you need to mention, that there has to be a present obligation. And it's probable that you'll be required there will be an outflow of resources to settle that obligation. And the third one is that you can actually measure that obligation, that money that you will pay, you can measure it reliably. So from all indications, those three exist. And for that reason, Daramsin needs to recognize a provision for this cleanup cost.
The third one, it says on November 1st, 2010, the Ramsey purchased an equipment at the cost of 10 million. The estimated useful life of the equipment was 10 years. The estimated useful life of the equipment was 10 years and was 20 years. On October 31st, 2016, the equipment was abandoned because of change in technology. So they abandoned it. So the equipment in its current state can be used in another line of business. The current replacement cost for the equipment equivalent size is 4.2 million because of the nature of the non-current asset. Value in use and net selling price are unrealistic estimates of the value of the equipment. The change in use would have no effects on the estimated life of the equipment. So how do we account for this? Can anyone analyze this for us? Sandra, can you analyze this for us? What are the principles here? How do we account for this here?
In impairment, calculate the value in use and compare it. No, we'll get the recoverable amount and compare it with the carrying amount.
Okay. That's also very logical because you're correct to a very large extent. So this is talking about impairment. I believe we have seen a question on impairment before here while solving some of these past questions. So this is impairment because of this, because they talk about, one, the asset was abandoned, though it has alternative uses. So when an asset is abandoned, just test it for impairment. You need to test it because its value might not be the value. The value might have gone down. And also they told us about value in use, net selling prices. So even though they told us that those value they are unrealistic estimate of the value. So it's not a value that we have here. They didn't give it to us. But they actually gave us the current replacement cost of 4.2 million. So you just need to speak about impaired. Here you talk about the principle that this asset is abandoned, so we need to test it for impairment by comparing carrying amount to its recoverable amount. Recoverable amount is the higher of fair value less cost of disposal and also value in use. But in this case, we're not given either of the two, right? So we have to use current replacement cost of 4.2 million as the recoverable amount. So you will also need to calculate carrying amount. Okay, since they bought the asset 10 years ago at a cost of 10 million and the useful life is 20 years, so you can calculate depreciation per annum, then multiply it by the cumulative years so far, so that you can get the accumulated depreciation. Then from there, if you take that away from the cost of the assets, we will be able to get carrying amount. You can then compare that with this replacement cost and see whether it's higher or lower. If it is lower, that means the asset is not impaired. That means the asset is not impaired. So in that case, you would recommend and tell them that this asset is not impaired. And that's really more of what we want to do here. So I have the solutions here for you. So you can use this to learn some of those principles. So
analyzed transaction one, where we outsourced our waste collection arrangement with Urban Waste and Co. I told them that the vehicle are used for Daramola waste collection only, so it's used exclusively for Daramola. They are painted in Daramola's name, so they are branded for Daramsin, and Daramsin can use the vehicle, so he has right to use. Vehicles are used nearly for all the life of the asset, so he obtains substantially all the economic benefits, and he also has, he can buy the asset if he wishes to, so meaning they can transfer the rights, the legal right of the asset to Daramola. So under IFRS 16, a contract contains a lease if it conveys right to control. And right to control means that there is an identified asset, and also the lessee has right to obtain substantially all the economic benefits, and also right to direct the use of the asset, right? So despite being labeled as an outsourced service, the arrangement meets the definition of lease under IFRS 16 because the Ramsing controls the use of the identified vehicle for the entire period. So the way this is treated is that it's going to recognize the right of use asset at the commencement date of the asset, and it would also recognize a lease liability, and this is recognized at the present value of the unpaid lease rentals. And at the end of the year, we're going to depreciate the right of use asset over the lease term, while the lease liability, we would amortize it using effective interest rate method. That is, you are going to be adding interest to it and deducting lease rentals. Okay? And so if the lease term is not explicitly stated, should be estimated based on the period of use or the useful life of the asset. So the second one is a lease of warehouse to Agro Allied. So from the case, we saw that Daramsin owns the warehouse, is the owner of the warehouse. He leased it to Agro Allied, who is the tenant, and the government intends to enact legislation requiring property owners to accept liability for environmental pollution. So owner becomes legally responsible for the cleaning up. So chemicals from Agro Allied have contaminated the land. So pollution event has occurred. So they have polluted the environment. The Daramsin has no recourse against Agro Allied or his insurance, so he cannot recover costs from tenants. And at year end, it is certain that the legislation will be enacted shortly after year end. So obligation event likely occurrence before year end. So the way we treat this is that under IS 37 that talks about provisions, contingent asset and contingent liabilities. A provision is recognized where there is a present obligation, either legal or constructive, arising from past events, and it's probable that there will be outflow of resources. And also, we can measure the resources reliably, we can measure the obligation reliably. So, in this case, the contamination occurred during the lease. So, they have already contaminated the environment. And at the end, the legislation requiring Daramsin to clean up is not yet enacted, but it's certain that they were enacted. So, there is an obligation and there is probable outflow. And so, if the new legislation is not yet enacted, but is virtually certain to be enacted, an obligation may arise if the entity's past conduct has created a constructive obligation. So in this case, the company has introduced an hazardous chemical policy. So meaning that by his action, he knows that he has to clean up. Additionally, Daramsin introduced a policy and applied it to its properties. This may create a constructive obligation. So he is already creating an impression in the mind of stakeholders that he will clean up. So because of this constructive obligation, that is, he has a published policy that he applies to its properties, and the contamination happened in past events. So it shows that he has created a public expectation that he's going to clean up. So he needs to make a provision for this cleanup. He will recognize a provision and he will measure it at the best estimates of the cost of the cleanup. Okay. So if the cleanup is happening much more in the future, you can discount that amount to present value, but if it's in the near term, there's no need for such discounting. Nature of expense, so you will include it in P&L also. And basically, that's the story. So I gave you lots more details here. And in the last transaction, this one is an abandoned equipment that we can reuse in another line of business. The cost of the equipment is 10 million, useful life 20 years. So depreciation per annum is therefore 10 over 20 years. They abandoned it in October 31st, 2016. So we're going to charge depreciation from 2011 to 2016, which is 3 million. So the carrying amount at the date of abandonment is 7 million, which is 10 million minus 3 million. The current replacement cost of the asset is 4.2 million. The asset can be used for another line, so it's not completely worthless. The value in use, we cannot determine. The net realizable fee, fair value less cost to sell, can also be determined. The remaining useful life of the asset is 14 years because it has used 6 years out of 20 years. So under IAS 16, an asset is initially measured at costs and subsequently at carrying amount, which is cost minus accumulated depreciation and impairment losses. So here, the equipment was abandoned, but it's not worthless because it can still be used for another asset, it can still be redeployed. So when an asset is abandoned or idle, it does not automatically mean you should change measurement basis. So which means that the entity should continue to depreciate the assets, even though it is abandoned, should continue to depreciate it unless it is impaired. So if it is impaired, it means that the depreciation, you still continue to depreciate, right? But it will be based on the new value over the remaining useful life. So IAS 36, which deals with impairment. So impairment loss only exists if the carrying amount is higher than recoverable amount. And recoverable amount is the higher of fair value less cost of disposal and value in use. But the question told us that both value are unrealistic estimates. So that means we cannot get recoverable amount. So alternatively is for us to use the replacement cost given to us. And since the um so since the equipment is still in use, it means that we'll continue to measure it at cost and all that. And the carrying amount we got it as 7 million. So depreciation would be 5 million. We'll still continue at 500,000 per annum for the remaining life of this asset. And also, if you decide to depreciate or if you decide to impair this asset, we will need to write it down to its recoverable amounts. But given that the value in use and the fair value less cost to sell, they did not give us. So management can use the replacement cost. So we'll write it down to 4.2 million. So there will be an impairment of 7 million minus 4.2. So note that when we say an asset is abandoned, it does not mean that the asset is derecognized or you take it out from your books or you stop depreciation. No. The assets would still be a PPE in the new line of business. So abandoned does not mean it's not useful. No. Just like it can trigger impairment. So here I just discussed and explained treatments for the examiner. I made the examiner understand that they did not give us recoverable amount, but it's possible for us to use depreciated replacement cost that they gave us. Okay. So, and I explained thoroughly that being abandoned does not mean that you stop depreciating or you would remove the asset from your books. No, you still continue to depreciate. You still continue to measure it at cost minus accumulated depreciation. You still continue to charge depreciation. And if management decide that, okay, we want to use, because the standard did not say we should use depreciated replacement cost as recoverable amount. No. But management can use their judgment and say, okay, let's use this amount as recoverable amount. And that means they will write down the value of the asset from 7 million to 4.2 million. And that's what is going to happen. I mean, that's just the general discussion around this. Any questions? Any questions?
Hello, sir. Hello, sir. Yeah.
Yes.
Sir, is it possible for us to reason all this within the limited time given to us in the exam?
It
I just asked.
depends. It
Okay.
depends. So it depends on, you might not
Individual.
necessarily write, yes, you might not necessarily write all of these details.
Okay, sir.
So what this is doing for you is just to expose you very well to this standard.
And reason towards these
So
dimensions.
yes. So you might not
Okay, sir.
necessarily write all of this. You might not necessarily write all of this. So
Okay, sir.
because it's 5 marks really. So
Mm,
for this, the points are very clear, especially for this transaction 3. It's clear that it just wants you to talk about abandoned asset. That you just explain the principle in IAS 16 that abandoning an asset does not mean you derecognize it from your books. You still continue to depreciate and keep it in your books, provided if it can have an alternative use.
okay. Thank you, sir. I'm grateful, sir.
Yeah. And some other further details as well.
So what about if there's no alternative use to it?
So if they tell you that there is no alternative use to it, to just impair the asset fully. So that's where impairment comes in. That's where impairment comes in. That means the recoverable amount of this asset is 0. So except, yeah, that means the recoverable amount is 0 because that means the value in use is 0. Except if they now give you net realizable value that we can sell it for this amount. I mean, that's where impairments actually do come in. So then you test it for impairment, then I know what its value is exactly. And those are the points you'll be talking about in the exam. Okay.
Okay, so when we do that, how can we not account for it since we want to sell it, or maybe we want to do it as a scrap? Is this same accounting method we use?
So if they give you the selling price and all of that, so all you just need to do is you would write the value down from whatever it is. You would you credit the asset, you debit impairment loss. So in your P&L. So the asset is written down to 0. So when you eventually sell it off, then you take it off your books when you sell it. So that if you're given such value, if the abandoned asset has no alternative use, so just impair it. Is either you're impairing it to 0 or you're impairing it to how much you can sell it. So the value becomes how much you can sell it. And at that point, it becomes a non-current asset held for sale. So, which we have also learned in this class. But if it has an alternative use, you would continue to depreciate it, while you can also test it for impairment. While you can also test it for impairment, but just continue to depreciate the asset, even though it is abandoned at that point in time. Forma, is that clear?
Yes, sir. Thank you very much, sir.
You're welcome. We are still going to solve more questions on accounting standards. So that would expose you to different standards and how to deal with them. Okay, so let's do cash flow. Let's do consolidated cash flow. Let's do consolidated cash flow. But I want to believe that every one of you here knows single cash flow. Am I correct?
You are correct, sir. As for me, I know single cash flow.
Okay. And I want to believe every person here knows single cash flow. Okay. So that answered my question. So we don't need to, but I've put some simple questions here on single cash flow that can help you and their solution that you can use as a revision for yourself, like that. Then so that we can do the one they will ask in your exam. Because what they will ask you in the exam is consolidated cash flow, not single cash flow. Consolidated cash flow. Okay, now, so Mr. Christopher.
Yeah, I'm hearing you, sir.
Okay, so can you do a summary of single cash flow for us? How it works?
But in the area of indirect method, I think The area of indirect method is the same with the consolidated, except that we do not have NCI and parents. Only what we have in the single cash flow is just that entity, and we apply all the relevant using operating activities. It's everything that we also have. That is also what we have in the single cash flow, except the group, which we have that differentiated, where we have NCI and other activities that concerns as associate. I think that's the only difference. Every other thing, they are the same.
Okay. All right, no problem. So let's do a general revision of it. So statement of cash flows is statement of cash flows. If you know single, you have known consolidated because there's no difference. And why I want to quickly take out this today is because it might be your question one. We never can tell. So I really need you to practice it down before well in advance. Now, the approach that I need you to have in mind for statement of cash flows is to have an understanding that statement of cash flows, according to IAS 7, is a statement of changes in financial position. Statement of cash flows is a statement of change in financial position. As soon as you can capture changes or movements in your asset, movements in your equity, movements in your liabilities, then you will have captured all cash elements that needs to be captured. So when I teach statement of cash flows, all I capture, all I pay attention to is movement in position. As soon as I capture the movement in position, then I'm done. It becomes so easy. So I noticed that a lot of students for cash flows don't even know where to start from. Some people will just jump to operating activities and start second guessing things. They don't know how to move. They don't have a strategy. You need to understand that the first thing you do is identify all changes in position. It's as soon as you capture all of that, then you're good. And that's what I would do for you today. So before I really jump to this consolidated statement of cash flows, let me show you how I apply those movements in position. Please give me 2 minutes. I want to get to the restroom. Just give me 2 minutes. So, as I was saying, when it comes to statement of cash flows, you need to have a complete understanding of it that is about statement of changes in position. And if you can identify all changes in position, you would prepare statement of cash flows easily. So look at the question like this now. It was 30 marks. So the examiner asked them to prepare a statement of cash flows. It's a simple statement of cash flows for 20 marks, and they asked them to use indirect method. So they gave them P&L, and they were also given statement of financial position, and they were also given some additional information. You see, this additional information When you read through it, you will see that all it is explaining is just the change in position. When I say change in position, I mean, when you look at your statement of financial position, your asset, you see they will give you 2 years. Why they always give you 2 years? It's just so that you can capture the movement. That movement is the cash flows. If there are any of them in between that is not cash flows, they will tell you. So, for example, now, if I want to solve this question, I will start with PPE in my workings. I'll start with PPE. I'll look at between 2024 and 2025, what will have caused the movement? And for PPE, the reality is that there are three things or four maximum that is in between this movement. The common one is addition and disposal. Then another one is depreciation. Then maybe there is a revaluation or impairment. That's all. So if there are any of these four, they will tell me in the question. And it's only movement in PPE that has this long list of movements in between. Every other one is addition or disposal. So, but for PPE, I can see that in note 7 here, they gave me a breakdown, a schedule. They already broke down the PPE into cost and accumulated depreciation. And because of that, I would also need to break down my movements in that manner as well. My movement of the PPE into cost and accumulated depreciation. Because if you see the carrying amount in 2024, which is the cost minus accumulated depreciation, it was 23,475, and 2025 is 29,235, which was the figures I have on the face of the account. So because they gave me this breakdown, you want to capture my movement, I will capture the movement for costs separately. I will capture the movement for accumulated depreciation separately. And if you look at all this additional information given to us, the first one talks about that a financial asset included in the trade investment with a carrying amount of 1.5 was sold for 1.8 during the year, while a replacement was also acquired. So all these additional note 1 is telling us, it's just explaining the movements in the trade investment. This trade investment here is just explaining the movement for us, so that when you are capturing your movement, you know what's in between. Note 2 talks about, it says there was an issue of 3,750,000,000 ordinary shares during the year at a premium of 32 kobo. What this is talking about is just that there was an issue of shares, which explain the movement in share capital and share premium. Note 3 talks about short-term investment is highly marketable with 1 to 3 months maturity profile. What this is talking about is that the short-term investment in your statement of financial position is a cash equivalent, meaning you don't need to capture the movement here. It's a reconciliation item. It's a cash on its own. Because cash equivalents are cash in hand, and they are cash at bank, and highly short-term investments that are easily converted to cash within 1 to 3 months. Those are cash equivalent. The note 4 is talking about that they pay the dividend. The note 5 talks about delivery van that cost 6.6 million with a carrying amount of 3.7 was sold for 2.5. This is talking about movement in PPA. Note 6 is talking about they are planning to take a loan. This is irrelevant in the scheme of what we are talking about, because they are still planning to take a loan. It has no substance yet. Note 7 is that movement. Note 8 There was a cash payment of 58 million in respect of insurance premium for the financial year ended April 30, 2025. That was totally omitted from the books. Okay. So they paid for insurance. They did not include this at all in the book. So we just need to include it. I will include it in my operating activities, and I'll also take it out for my cash when I'm doing my reconciliation. That's basically what I'm going to do here. So all this long list of additional information majorly is explaining to me movement in positions, explaining what is in between them. And that's what I would do first. So in my workings, first, I started with my PPE, with the cost of PPE. I do the movements that, okay, what's the opening balance? 45,795. From that, note 7, that cost opening 45,795. So what will have cost movement? They told me that they sold the delivery van. They told me in the question in note 6, note 5, that delivery van with an original cost of 6.6 with a carrying amount of 3.7 was sold for this. So when I'm doing movement in costs, don't go and capture carrying amount, nor sales proceeds. What you should capture is the costs of that asset, because I'm doing movement in costs, and anything that goes to asset account is always at costs. It's always at cost. And since I'm working with costs, so this is the opening cost. So what I need here is the cost of the asset that was disposed. And that was the only thing they told me in this additional information. They didn't tell me about that they bought any additional asset. So that will not come into play at all. I cannot assume that they bought. I cannot. So aside disposal and addition, what can cause movement again is depreciation. But since I'm treating depreciation separately, so it's not coming to costs. I'm treating it under accumulated depreciation. It's not coming to cost. So there's no addition. But is there evaluation surplus? That they will not tell you, because you need to figure that out yourself. Is either you go to your P&L and see if there is any OCI item and see if there's evaluation surplus for the year there. In this question, they did not give us OCI. So the next place for me to go is my equity. And thankfully, there was evaluation reserve here. At the beginning, it was 9195. At the end, it was 11280. There is a movement there, meaning there is an increase. The difference is the evaluation surplus for the year. One leg goes to equity, the second leg goes to asset. So this also causes movement in asset. So if I accumulate these three, I'm expecting my closing balance of my cost to be 41,288. But was it 41,280? No, it wasn't. From the schedule given to me, the closing asset was 55,395, meaning my asset increased. What will have caused the increase? Only one thing is acquisition of assets, meaning there was an acquisition of PPA. And these I'll take to statement of cash flows under investing activities. And that's what movement does for you. It exposes cash flow items as balancing figure. Now, for the accumulated depreciation, the opening balance from the schedule, the accumulated depreciation was 22,320. They did not give me depreciation for the year directly. I was not given. They did not tell me anywhere. So I can't just assume. So, but I will walk to it. But I can get depreciation on the asset disposed, because that one was disposed. I need to remove it from the books. And given that I was given the cost of the asset disposed and the carrying amount of the asset disposed, the difference between the two is the accumulated depreciation on the asset disposed. If I remove that, my expected closing balance of my accumulated depreciation should be this. But was it this? No, it was actually 26,160. It's increased. That increase is depreciation for the year. And since I'm using indirect method, this will be useful because I need to add it back. And finally, anytime an asset is sold, we would definitely need to determine there would definitely be a profit or loss on disposal. I was told in note 5 that they sold the assets for 2,520 and the carrying amount is 3,750. So I made a loss on sale of 1,230. And don't forget, these sales proceeds will go to statement of cash flows under investing activities because that's the money received. That's the money received to go to statement of cash flows. So it is only PP that has this plenty wahala. And really is always like that. Know this, you're good. Then I'm done with PP. I'll move to intangible asset. You will see that one increased from 16,300 to 18,775. Since the additional information didn't say anything around intangible assets, I will just do the movements. Opening 16,300, the closing 18,775, difference 2,475. That's an increase in intangible assets, meaning we bought more assets. It goes to statement of cash flows under investing activities. Yes, Former, can see your hand.
Sir, please, where will the loss on disposal go to?
Since we are using indirect method, it will be added back because they will have treated it as an expense in P&L. So we need to add it back in cash flow as a non-cash item.
Okay, sir. Thank you.
You're welcome. And that's intangible asset. Then I move to the next item, which is trade investment. This one went down from 2,860 to 1,835. But the question already explained to us in this note 1, the movement in trade investment, that they sold some trade investment. Yes, Sandra, please go ahead. I can see your hand.
Okay, sir. I was about asking that the note 1, financial asset, was it not supposed to be under the intangible asset before?
No, it should not. I
Okay.
cannot, I cannot just assume that financial asset is not even an intangible asset. So, and thankfully enough, they told us specifically that it's a trade investment. So good for us, no confusion.
Thank you.
So I will capture movements in that too, since I already know that they sold. But what they gave me is carrying amount of 1.5 and sales proceeds of 1.8. What I will capture in my movement is the carrying amount because those figures on the face of the statement of financial position are carrying amount. So I do the movement. At the beginning, 2,860. They sold 1.5. This is carrying amount because this also is carrying amount. So I remove carrying amount. I expect my balancing figure to be this, but on the face of the account, it was this. So it increased. So this 475 is this increase in trade investment. It means I bought additional trade investment and it goes to statement of cash flows. And they also gave us a clue. If you read that note 1 very well, they said they sold and they said they bought a replacement was also acquired. So I'm not surprised that we eventually got an increase as balancing figure. And anytime there is a sale, you need to determine a profit or loss on disposal or on sale by comparing the carrying amount with the sales proceeds. So 1885 minus 1.5, which I did here. Profit or loss on disposal of trade investments. Sales proceeds 1885. Book value 15. Difference, gain on disposal of trade investments 385. This sales proceeds would go in as statement of cash flows under investing activities as an inflow. And I'm done with that. Look at the way I'm moving from one item. That is how to do statement of cash flow. So at any level, if you don't do this, everything will just be scattered. You eventually do it, but you will not be structured. You'll be going from here, you will not know, you'll not be sure what you're doing. You have to sequentially touch every item of assets, liabilities, and equity and be able to explain what's happening in between. Just do the movement. The one that they are silent, that they didn't tell me, because you cannot assume, don't assume at any point in time that this may be this. Like this intangible asset, they did not mention anything around it. I did not assume. I just looked at opening 16.3, closing 18.775. It increased acquisition. This trade investment, they told me that they sold. That's why I removed disposal and at carrying amount. And I compared what my balance, what I was expecting my balance to be, and what I have on the face of the account. I saw that there's an increase acquisition. Okay, good. So the next one is the trade and other investments. This one also, I was not told about the movement. They didn't mention anything. Fine. It means they make my life easy. So I'll capture at the beginning was 25,335, at the end it's 1,440. Increase, acquisition, outflow as well. The next one, short-term investment, I will not touch that because they told me in the additional note that that's a cash equivalent because it can be liquidated between 30 to 90 days. So it's a cash equivalent. Same thing happens to the cash in hand. I won't have to do much with that. Then my equity and liabilities, you already told me about the movement in that one, that they issue that they issue shares to that. So I just need to, you see that it increased from 11,250 to 15,000. The movement is issue of shares. So that the additional note confirms that is a cash movement. So I did the movement in my workings. The same thing for the share premium too, it increased. For the evaluation reserve, that one, I already know that the difference is evaluation surplus that I've already treated. For the retained earnings, 13,860 and 17,925. The movement between these two, can you help me calculate the movement, please? I don't know, does anybody have calculator there? What's the movement between the two? This evaluation surplus.
You the retained earnings.
Sorry?
Is it for the retained earnings?
Yes, retained earnings.
Okay, 4065.
Okay, so this 4065, what does it relate to? Increase in retained earnings, what does it relate to? What can we attribute it to? Anyone?
Okay. Can we say profits? Profit of the year. Profit for the year. Profit for the year.
Yes, that's exactly what it is.
Yes.
So let's go to P&L and see if it's 4065. So what's happening? The profit for the year is not 4065. It's actually 9465. What's happening? Why is there a decrease?
They must have paid dividend.
Thank you very much. Thank you very much. And if you do that 9465 minus that 4065, it will give you this dividend in notes 4 or 5,400.
Okay.
So this movement in retained earnings, it exposes the dividend. It tells you what the dividend is. I did, so just do all the movements. It would work, it will work out everything. The next one is loan notes. It moved from 6.5 to 12.780. They didn't tell me anything. The only thing they told me about is the fact that they are planning to borrow money in note 6. That one, I will ignore that one. So this movement from 6.5 to 12.780, I will just take it as I borrowed money, more loans to me. For deferred tax, usually you have to deal with deferred tax and current tax together. You aggregate them together as one. So I will put together this deferred tax opening of 3,750. Under current liabilities, there's current tax opening of 8,460. I will just add it together. In my P&L, you will have been given tax expense for the year of 8,850. You know, this tax expense for the year does not necessarily mean what you actually paid for the year. You might not have paid all. So, but this is your tax expense for the year. So by the time, let me show you the movements in that. So for taxation, the opening, I added the deferred and current. I added the tax expense for the year. So I'm expecting my closing balance to be this. But my closing balance was actually for deferred and current was this. So it decreased from what I expected it to be to 10,740. So there's a decrease of 10,320. It simply means you paid tax. It means because for your liability to decrease, it means you have settled. You pay tax. And that's how you deal with tax from that movement. Then I moved to trade payables. This one increased from 9,150 to 12,10, 12,810. It means that you borrowed more money, inflow. Bank overdraft, you ignore that because it's a cash equivalent. And that's it. See, if you can capture all of these movements, I've captured everything: inventory, receivables, share capital, share premium, retained earnings. You are done. That's, you see. For the statement of cash flows now, for indirect method, we usually start from operating profit. If you're not giving operating profits, you start from PBT, profit before tax. And from the P&L, the PBT was profit before tax was 18,315. So what you need to do here first is to work back to operating profit. And working back to operating profits, this finance cost of 5,220 that has been deducted, just added it back. Just add it back. You add back the 5,220. That's the first thing you do, so that you are back to operating profit. When you're back to your operating profit, what you then need to do is then to consider, what you want to do is that you want to convert these operating profits to a cash profit. You want to get cash from operations. So you just need to move up systematically. I will start with admin expense. This 25,000. I will ask myself, this admin expense that they deducted to get this profit, Is it cash? Is it a cash expense? If my answer is yes, it is cash. That means it's fine. It's fine. Because I'm okay if it is cash. But there are few items that will always be non-cash in admin. And there are popularly three: depreciation, profit or loss on disposal, impairment. We have two of them in this question, and we assume that they have all been treated in admin. Depreciation, where we got depreciation when we're doing movements in accumulated depreciation. This is depreciation. We got loss on disposal of delivery van, and we also got profit or gain on disposal of trade investment. All of these items are already captured within admin. They are all non-cash. All these ones, we need to eliminate them because we don't want them in our, they cannot be considered when determining our cash profit or cash from operations. So we need to reverse all of those. And that's what we call adjustment for non-cash items. First, depreciation. This is an expense that will have been deducted, so we add it back. The same thing for loss on disposal of delivery van. This is an expense that will have been deducted, we add it back. Then gain on disposal of trade investment. This is an income that will have added, so we deduct it. When we cumulate the three of them, it gives us this amount. It gives us this amount. So I'm done with admin. I've dealt with all non-cash items in admin. I move to interest received. Interest received is an investing activities item. It should not be considered in cash from operations. It should be dealt with in investing activities. So it was added here in determining this profit. I will deduct it. So that 1670, you see me in my operating activities removing it. You see that I'm removing this 1670. Not because of anything, but it's because it should not be here. Or rather, it should be in investing. You see that I treated it in investing as an inflow because it's an investing activities. Interest received is interest you receive from your investment. And typically it will come from this trade investment. And that's all I'm doing for this interest received. So I've dealt with that. I've reclassified it away from operations to investing. The next item here is cost of sales. For my cost of sales, this 118095, is it entirely cash? No. Because in cost of sales, there is inventory there. Inventory is non-cash. Inventory is non-cash. Also, in cost of sales, there is purchases. And in purchases, there might be some purchases that I have not paid for, which is trade payables. So if I check my movement in position and I see that there is an increase in trade payables, I have to remove that. If I see there is an increase in inventory, I have to remove that because they are non-cash. Also, my revenue, this 164985, is it entirely cash? Is it inflow totally? Is it cash? It depends. In my changes in position, if I see that there is an increase in receivables, that means that portion of receivables, that's this 164985 includes both I received and the ones I did not receive that I have not collected. The ones I have not collected, that's what we call receivables. So we are going to remove that. And because the non-cash items in cost of sales are revenue, they are majorly items of working capital. So IS7 in its templates decided to call it adjustment for changes in working capital. So I already did all these movements, which is why I said the first thing you do is movement. So increase in inventory is non-cash. So I'm just removing it. But the easiest way for you to interpret this in the exam is that when inventory increases, it means you are buying more inventory, outflow. When trade payables is increasing, it means that you're selling more. It means that you're giving out goods. You're giving out goods. That's why your receivables is increasing, outflow. Increase in trade payables, it means you are owing people more money, which means they are giving you something. That's why you are owing them. They are giving you something. So inflow, you must have collected something for you to owe people. Inflow. So you cumulate these three together, it gives us this. Then that means I've dealt with all the items in my P&L except tax. And I've already done the movement in tax. I got an outflow of 10,320. Then I did that insurance premium that they told me that I paid that I omitted from the books. I removed it from since they have paid it already, I remove it from here. So when I accumulate all the items together here, I will get net cash inflow from operating activities. And that is how it works. You need to be systematic about these things. Otherwise, you just be here and there. You need to have an approach. You will get 100% in cash flow. Then investing activities. Items here, you just go to your statement of financial position systematically also. Is basically your asset part. First, your PPE. And in your movement in PPE, you have already identified disposal and acquisition. You already identified that. From the movement we did, we saw that there was an acquisition of 14,115, and they also told that there was a disposal. So I need the cash, not the costs. Don't go and put carrying amount or cost of the asset disposed or carrying amount of for sales proceeds. I need the sales proceeds itself. Acquisition, that one, yeah, balancing figure, the cost. And those are the two that goes to investing activities as far as PPE is concerned. So acquisition of PPE, sales proceeds of delivery van. Then after PPE, the next item is intangible asset. I already did the movement in my workings and I saw there is an increase. I saw that there was an increase. I'll put that as an outflow. The same thing for the trade investment. I saw that there was an increase of 475. It's an outflow. And I saw there was a sales proceeds inflow. So I disclose all of that. Acquisition of intangible asset, acquisition of trade investment, sales proceeds of trade investment. You see that I have touched all items of assets except current assets, and I've dealt with all of this. Inventory, trade, and these ones I've already dealt with all of them in my adjustment of changes in working capital. And don't let us forget the interest received that we reclassified from operations to investing. And that is all for investing. I'm sure that I've touched everything in asset. Then finally is financing. This one, equity and liabilities. That's where you'd deal with items here. Under my equity, I capture increase in share capital, increase in premium. I already know that this increase in reserve is non-cash. It impacted asset. I already captured this increase in retained earnings and I've identified that there is a dividend paid. that I will put in my financing activities. I would pick this increase in liabilities as an inflow because I'm borrowing more money. I've already captured tax. I've already captured payables. Bank overdraft is a balancing reconciliation item. Current tax payable, I've already captured it in tax. And that's all is happening in my financing activities. Increase in share capital, increase in share premium, dividend paid, increase in loan notes. And don't let us forget the finance costs that we had to add back in operating activities to work back to PBIT. And you come and actually treat the item here in financing activities. And I mean, I can confidently pick the whole item in P&L because in my liabilities, there was nothing like interest payable. So I wasn't owing any interest to anyone. So that means the item in P&L was actually paid fully. And I accumulate all of these, I get net cash inflow from financing activities. And after you have done all that, then you do your reconciliation of cash and cash equivalent. And doing your reconciliation of cash and cash equivalent, you do the opening cash and cash equivalent. These are gotten from your statement of financial position, the short-term investment, the cash in hand, and the bank overdraft is coming in as a negative. When you cumulate it, I have an opening cash and cash equivalent negative. You would add it to cash and cash equivalent during the year by adding the balance you got in operating, investing, and financing. I have a positive of 2522. When you cumulate these two together, you get 1858, which is the cash and cash equivalent at the year end, which must exactly be the same as your closing cash and cash equivalent in your statement of financial position, which I analyzed there. Short-term investment was 3810, cash in hand, bank overdraft, and don't let us forget the omitted insurance premium that they have not removed from my cash. And it gives me exactly the same as what I got here. And that is how, this is the proper way to prepare statement of cash flows. Now, there's another one on direct method, but I want to see this question on, let me solve this question on consolidated cash flows that was indirect, since I just solved the question on indirect method. So let me deal with indirect. Let me see the second question that they asked a few days ago. Is that direct or indirect?
Hello, sir.
That's also indirect.
Oh,
No problem.
indirect.
It's indirect, yeah. No problem.
Yeah.
So
Hello, sir.
let's just solve the two statement of cash flows. Yeah, I can. Yeah, I'm with you. Go ahead, please.
Okay, yeah, I just want to ask, is it possible for them to ask any of the two?
Yes, so. Yes, so. They can ask any of the two. So you need to know any of the two. I will explain the right method, but I just want to deal with statement of cash flows so that time will not catch up with me because it's already 10:30 now. Then if you still have time left, then I will show you direct method. It's the same. Just do your movement in position. I know a lot of you have a way of doing it and it's difficult for you to adjust, but this is easier, I can tell you that. And it captures everything that you need to capture. Okay, so now the methodology for preparing statement of cash flows does not change, it's the same. So, but when it comes to consolidated, you know that the approach is movement, movement, movement. So there are some items you will see in There are some items you will see in your statement of financial position. Okay, there are some items you'll find there, and you need to then be able to capture the movement also. Items like goodwill, you see NCI, you see investment in associates and all that. You see those items in you see those items in your statement of financial position. So when you see those items, how do you capture the movements in such situation? For goodwill now, goodwill is determined by comparing your purchase consideration with net asset acquired. That net figure is goodwill. So in that, the relevant cash flow therefore becomes the purchase consideration, because that's the net cash flow there. So if they give you goodwill in the account of 100, and the way it's derived that is 500 minus 400. So 500 being the amount the parent paid, 400 being the net asset acquired, and you have 100 as goodwill. And they say, okay, in this 100, what's the cash? Is the 500, which is how much was actually paid. That's what we need in statement of cash flows. How much was actually paid? So that's for goodwill. For NCI, when you have NCI in your consolidated statement of financial position, the breakdown of that, or the way it's determined, is you get NCI value, you add share of profit, and they usually always deduct dividend if paid at all, if it's available. So in there, the only cash item is that dividend paid to NCI. That's the only cash item when it comes to NCI. That's the only item that is relevant for us in cash flows. And also is investment in associates. The way investment in associates is determined is you will do cost of investment, share of profits, dividend received, and that's it. The relevant cash movement there is the amount we paid, the cost of investments, the investment we made in the associate, and also the dividend we received from the associate. Those are the relevant cash movement there. And those are the only new things there. Every other thing is just examine the movement as I've explained. So these are the items that are peculiar to consolidated account, and these are how to get the movement. And that is all. So let's solve two questions, a simple one and an advanced one. And you should be able to practice, at least if you can practice one or two more, you're done. Just if you can be done with statement of cash flows today, good for you, so that you can move to other things. So for this one, we're asked to, you were asked to prepare a consolidated statement of cash flows for Papaya PLC for the year ended December 31st, 2022, using indirect method. So please always carefully look at the method that the examiner wants you to use. Don't just start solving. No, use the method they ask you to use, because they'll specify the method. They always specify the method. So now they say using indirect method here. And again, my approach movement, just go to your statement of financial position and do your movement. After you are done with that, then go and prepare your statement of cash flows. Movement is everything. This additional information, all it does is explaining those movements to you. If you look at the additional information one, they said all other subsidiaries are wholly acquired, are wholly owned. we really would do little with this information. What is important is the one they give us information about. That is the one we're going to deal with. The other ones that are wholly owned, that's fine. They also gave us information about depreciation. Good. Since we are using indirect method, I know I will need to add back depreciation. So it's fine they gave me. I was also told that there were no disposal of PPE during the year. Fine. So that means I won't need to bother myself about whether there is disposal or not, because they already told me that there is no disposal. Therefore, I know that there would not be anything like profit or loss on disposal. I'm also told that goodwill is not impaired, so I will not bother looking for impairment of goodwill because it does not exist. And finally, they told me NCI is valid on a proportional basis. So when I'm getting movement in NCI, I know how to get the value of NCI. I will just get percentage of NCI times net asset acquired. That will give me NCI value. Okay, so the only relevant thing here is just depreciation of 2.1 million. Every other thing is just giving me something to note. So now, the question itself says on October 1st, 2022, Papaya acquired 90% interest in Bafana Limited by issuing 1 million ordinary shares at an agreed value of 2 naira per share, paying 1 million in cash. Okay, so from here now, I know that Papaya is the parent company and he acquired 90% in Bafana and he issued shares of 1 million of 2 naira each and also pay cash. So that means purchase consideration comprises share consideration. He issued 1 million shares and he also paid cash. For cash flow purposes, I know it's the cash that is relevant that would go as investing activities because that's what I'm paying, cash. And the net asset of the subsidiary acquired are this. So PP inventory, receivables, cash, trade payables. So net asset of the subsidiary is 2.6 million. Net asset of the subsidiary is 2.6 million. I'm then given the consolidated statement of financial position of Papaya as at December 31st were as follows. So I'm given movement in position. So I will use this to get all my movements. And I'm given P&L as well. And I'm also given changes in equity. So when you see cash flow, you know the first thing you do, start doing your movements. So I start with my PP. Opening 23, closing 25. Here, they didn't give me any schedule of PP, so I work with carrying amount. So what are the relevant movement? I already told you what can happen between these two figures are 3 or 4. One is addition, 2 is disposal, revaluation, impairment. So in 2021, since this is consolidated, you know that these values will include value of the subsidiaries too, since is a consolidated account. So the movement will be 23 plus subsidiaries PP of 19 up here. Then minus depreciation. They told me there was depreciation of 2.1. Okay, let me just show you. Opening 23, subsidiary 19, depreciation, I remove that. I expect my closing balance to be this, but my closing balance was actually 25. So it increased to 25. It's increased by 2.2. That is acquisition of PPE, and that's an outflow. And I'm done with that. I move to the second one, which is goodwill, which is 660. That moved from 0 to 660. So in this case, I just need to look at the movement in goodwill, which is the purchase consideration minus net asset acquired. So purchase consideration here, they told me in this first paragraph that it comprises share consideration and cash consideration. What I need is the cash consideration, which is 1 million. So I paid 1 million. However, if you look at the assets I bought, the subsidiaries asset, there is cash there. There is cash there. So in that case, my purchase consideration will not be 1 million anymore. It's going to be 900 because I paid 1 million and I'm collecting back 100 because I paid 1 million to acquire your assets. Part of your assets has a cash of 100. So how much have I paid effectively? It's 900 because indirectly I've collected back 100. So it's 900. And that's what I did in this movement for goodwill. So it relates to goodwill only arise when there's acquisition of subsidiary. So purchase consideration 100, the cash and cash equivalent acquired, purchase consideration 1 million, cash and cash equivalent acquired 100. So there's an outflow of 900 here, which I'll put in investing activities. I move to my inventory. So this one, just look at the movement, but don't forget to include subsidiaries inventory of 700. So it will be 12 plus 700. Compare that with this 14.5. The same thing for the receivables. 11 plus 300. Compare that with this 13.7. I will ignore the cash because it's a reconciliation item. And that is what I did here for the movements. 12 plus subsidiaries on 12.7. I compare that with the closing. There's an increase in the inventory outflow. For the trade payables, the opening 11,000, subsidiary 300, expected closing 11.3. I compare that with the 13.7. So there's an increase of 2.4. It's also an outflow. Then I move to share capital. I also do the movement in share capital. So in share capital moved from 10,000 to 11.5. So 10,000. All I've caused the movement, they already told me that I issued shares of 1 million, but at 2 naira. So the value that goes to share capital will be the nominal value of 1 naira. So the increase here is just 1 million. The remaining 1 naira would impact share premium. So there is another 1 million naira increase in share premium too. So those are the movements within these guys. So, and that's what I did here. For share capital, I did the opening. There was an issue of shares. This one is non-cash because the parent just issued shares to acquire holding in the subsidiary. So I won't really deal with this. So also, the expected closing is 6 million, is 11, but I had a closing of 11.5. So that means there's a cash. There's an inflow of 500. The same thing for the share premium, opening 5,000, issue of shares 1 million, expected closing 6 million, but my actual closing was 500. So it increased by 500. So that's an inflow. And that's for the share capital and share premium. For retained earnings, the same methodology. This one will help us expose if there is any dividend paid to our shareholders. And if you look at the difference between 17,910, let me see, 17,910 minus
This is
15,300 is 2,610. That should be the profit for the year. And that is it. That's the profit attributable to owners of parent, which is 2,610. That's profit. It's not a cash movement. So Since the movement is equal to profit, that means there was no dividend paid, so I ignore that. Then I moved to my NCI. So this NCI, again, the way it's determined is I need to get value of NCI. Since parent acquired 90%, that means NCI is 10%. So value of NCI is 10% times 26, which is 260. I will add his own share of profits, which from P&L here, which from consolidated P&L here is 90. That is share of profit. So 90 plus 260, that should be around 350. If I compare that with this closing of 310, so it decreased because it paid dividend. So the difference is dividend paid to NCI because it's usually a reduction instead of changes in equity. So I did a movement for you here in NCI. The acquisition, 260, share of profit, expected closing. So the difference is dividend paid to NCI. Then trade payables, which is the next item after NCI. This one increased. I'll just do 15.2 plus subsidiary 400. I compare it with this. Any increase will be an inflow because it's a liability. The taxes, here we don't have any deferred tax. So I will just do my tax, which is 1,000 plus the tax in P&L, which is 1,005. So that's 2,500. Compare it with this decreased by 1,000, then that will be an outflow. It's like I paid tax. So 1,000 plus income tax expense, expecting my closing balance to be this, but it has reduced, which means I've paid tax. I've done all my movements. I've touched all my movement. Then I can immediately prepare my statement of cash flows using indirect method. For indirect method, I should start with operating profits. But since we're not giving operating profits, they gave me PBT. I was given PBT, profit before tax. And in this question, we don't have finance costs. If you look at it, I have profit before tax of 4,200, and there was nothing like finance costs. So I just deal with this admin expense immediately. And in this admin expense, based on the information I've gathered from all the movement I captured, the only non-cash item in admin is depreciation. Is that depreciation of 2,1. And that's why for adjustment for non-cash, I only dealt with depreciation, which is 2,1, and I'm adding it back. As soon as I'm done with admin, my cost of sales and revenue, the non-cash there are inventory, payables, and receivables. I deal with them under adjustment for changes in working capital. And I've done all the movements. There was increase in inventory. It's like I'm buying more inventory, outflow. There was increase in receivables. It's like I'm giving people more goods, outflow. Increase in payables, I'm collecting money from people, inflow. That's an inflow. So I accumulate all of this together to get this. I've dealt with this is like my cash profit already. But I need to deal with the tax, and I've gotten that there was an outflow of 1 million. So this gives me my net cash inflows from operating activities. For investing, there are just two things in non-current assets, that PPA and goodwill. And I already established from the movement that I acquired PPA of 2.2. And for my workings for movement in goodwill, we paid subsidiary 1 million. We took over 100. So effectively, I paid 900. So if I add the two together, 3.1. For my financing, I identified inflow for share capital and share premium, 500 each. my dividend paid to NCI for movement in NCI 40 outflow. If I accumulate this, I get 960 as net cash from financing activities. Then I reconcile cash and cash equivalent. So during the year, if I accumulate the operating, investing, and financing, I get 260. For my statement of cash, for my statement of financial position, my opening cash and cash equivalent is 500. If I add the two together, I get 760, which is exactly the same thing as what I have in my cash and cash equivalent at the end. Look at current assets, 760. And that's what shows that you have done the correct adjustment. And that is all. As you can see, movement does it all. You capture the movement, your cash flow is ready. It is ready. Any questions?
Sorry, sir. Yes, sir.
Yeah, Emmanuel, continue. I can hear you, please.
Okay, so for indirect method, I thought that we could start with profit from operations, right?
Yes.
That's profit before tax minus our finance cost, right?
Yes. Yes.
But like this question, we are not giving finance cost. So we just use the profit for tax and continue.
Yes.
Okay, thank you, sir.
So your question wasn't right? You're missing something. So if you said profit before tax minus finance cost, that's not what gives you operating profit though. What gives you operating profit is profit before tax plus finance cost, which is why in the first question I did, you see that we added back the finance cost. Manuel, are you there?
Yes, I'm here, sir. I'm here.
Hope you heard what I said clearly.
Yeah, you said it should be the addition of finance cost, not deduction.
Okay, yeah.
Thank you.
I'm waiting for questions though. That's why I'm waiting.
Hello, sir.
Yes, Mr. Christopher.
Yes, ask a question. The question I want to ask is this. The best approach that we will use that will make us faster in the exam, I think you should give us that approach. Because if we decide to finish all the workings before posting them, I think it will delay us. We may not even finish this question. Can we be posting as we are doing the workings, we'll be posting at the same time? Will it be better for us
Don't do
like that?
that. Don't do that though. The way they mark SBR, that's why people fail SBR. The way they mark SBR is not, they don't mark final answer. Nobody cares about whether they mark methodology. So, and in a question of 20-25 marks, you have, if you multiply 20 by 1.8, if you have like this question now, it was 25 marks. Am I correct? It was 20 marks. If you do 20 times 1.8, let me check. 20 times 1.8. So you have 36 minutes for this question. The most important part, if you can use even 20 minutes to do movement. You are getting, the examiner is marking all your movement is not in vain. No. That's out of this 20, that can
Okay.
give you like 14 or 15 marks already. That is what the examiner marks. Even if you don't prepare the statement at the end of the day, you get like 14 or 15 marks. I will show you the
Okay.
marking scheme, the way they mark. So please don't
Okay,
use
sir.
shortcut. If anybody is telling you about one shortcut, it does not exist. It does not exist. You have to be methodical. So
Okay,
that's why
sir.
the examiner mark your steps, and like that. It's not the statement they are looking for. It's all of these things you're seeing. You're getting marks for all of them. 3 marks, 2 marks, and all. You are getting marks for all of them. The statement itself is easy to prepare because all of these things, all of them, I'm getting all of them for my movements. As soon as you do your movement, you are done with you are just allocating them to where they belong. That's all you're doing. Go and resolve these questions and use it. So as soon as I finish this one, I will send you another question on cash flow for you to go and practice again using this method. Get used to it. It maximizes your mark in the exam.
Okay, sir. It's okay, sir.
So let's solve
Thank you,
any
sir.
other questions. Yeah, you're welcome. Any other
Yeah.
question?
Yes, sir.
Yes, Manuel.
Okay, so I noticed that when you're doing your calculation for ordinary share and share premium, you use the nominal value for both of them.
So since they issued the shares at 2 naira, and from the question, I can see that under this equity, my share capital is 1 naira. That means the nominal value is 1 naira. So the extra 1 naira is premium. So it's just a coincidence that it's 1 and 1. So I think this 1 naira here is the nominal value. This 1 naira here is the premium. Because they issued the shares at 2 naira. And if nominal is 1 naira, the extra 1 is the premium.
Okay, sir. Thank you.
Mr. Eze, are you sure you are with us? Yeah, I thought as much. He's not with us. Ufoma, Sandra, Matthew, are you sure you guys are with us? I hope so.
I'm with you, sir. Just a bit overwhelmed.
Why are you overwhelmed? Should not.
A lot to cover.
There's always going to be a lot to cover, but I mean the one you are doing at the moment, focus on it, know it, practice it, move to another one. The bit you can do is the bit you can do. I mean, people are busy and all that. You cannot kill yourself. So, like if I were you, most of these questions I'm solving for you in this intensive, I'll just solve it, practice it. All the ones on ratios, all those questions on accounting standards, EPS, now statement of cash flows, I will just practice them over and over, get to know them, and hopefully I'll be able to apply that knowledge. Then it gives you confidence. If this is the only thing you study, this is not the time you want to start picking one fresh topic, one this, one. You cannot do that. That would shallow your confidence. It's going to destroy your confidence. If you want to build confidence, read some specific things and know it very well. Because what we are doing here in this intensive are things that they ask in the exam. So if you know these ones very well, it builds your confidence. that even if they don't ask the same thing, you can apply knowledge because you believe you know it. I've read this one. I know this one very well. You would pass. That's how to build confidence. But when you are here and there, that one, this one, that one, this one, this one, it feels as if you don't know anything. And it's a problem. It's a confidence killer. Build confidence. That's what this is meant. So let's solve this one. This is a more advanced question. And it's not that it's advanced. You just have plenty more additional information. That's just the difference. So it's not advanced anything. It's still the same methodology. So let's look at the question. I go to requirement first in my questions. I want to know what they want me to do before I do any other thing. So this is what the examiner is talking about. They say prepare breakthrough group consolidated statement of cash flows for the year ended December 31st, 2023 using indirect method. So they want us to prepare statement of cash flows using indirect method. So for this one here, is similar to what we have done before. We're doing statement of cash flows. And here, we're required and they also have a B part, and we have solved this B part before. We solved it last week on provisions. So that's this one. So let's then read the question. Okay, so it talks about Breakthrough PLC is in the process of releasing its financial statements through one of the daily newspapers on or before May 31st, 2024. The following drafts were prepared by the company's chief accountant. So they give us consolidated statements of financial position, and we're also given consolidated statement of profit or loss, and also we're given a statement of recognized income and expense. This is like OCI. This is like other comprehensive income. And we're also given statement of changes in equity. So they give us some additional information. They said any impairment on goodwill has been included in the draft financial statement. So this one is telling us that there is an impairment in goodwill. There's an impairment in goodwill. Number two, it says there was no disposal of PPE. There was no disposal of PPE during the year, and depreciation charge for the period was 120 million. So yeah, we don't have, they said they did not sell any PPE during the year, but they gave us disposal of 120 million. They're giving disposal of 120 million. And three, it was established that there was no actuarial gains and losses also. It says it was established that there was no actuarial gains or losses. So here we don't have any actuarial gains or losses. Also, number four, it says included in dividend paid during the year was 800 million paid to Waterside PLC, a subsidiary company through which Breakthrough PLC conducts its investing activities. The transfer was made on January 1st, 2023 for a specified portfolio of investments, but no transfer of profit or loss occurred. 95% of the profits and 100% of the losses in the specified portfolio of investments are to be transferred to Breakthrough at the end of the year annually, and the capital is expected to be returned in 4 years' time. So here, they are saying that we paid a dividend of 800 to one of our subsidiaries through which we conduct our investing activities. So we transferred, the transfer was made in 2023 for specified portfolio of investments, but no transfer of profit or loss occurred. So 95% of the profits and 100% of the losses in the investment are to be transferred to Breakthrough at the end of the year. And the capital is expected to be returned in 4 years' time. Okay, so this is the statement of financial position of Waterside. The investments, this is the share capital, and is making a loss, so it has reduced to 780. Also, we're told that Breakthrough is yet to make provision for its 75% acquisition and holding in Dandy PLC on January 1st, 2022. However, the company wants to set up a provision for a construction cost of 20 million retrospectively on the acquisition. The fair value of the net asset acquired were as follows. So we also acquired some 70% in Dandy on 4th January 2022. And we want to set up a provision for a construction of 20 million on the acquisition. So this is the net asset of the subsidiary. It's 320 million. We paid 200 million. And 50 million is a deferred consideration, meaning an amount we will pay in the future. The difference between the discounted value of the deferred consideration and the amount payable is included in interest expense. Okay. So the difference between the two is included in interest expense, because you know that anytime we have deferred consideration, so this 50 is like a present value. They will discount it to present value, but the future value is 58. So as you move to the future, because this is end of 2023 now, they will have unwound the discount of it. So that's why they are telling us that the 8 will go to interest expense at the end of the year. The difference between the discounted value and the amount is an interest of, the difference is interest expense. Number 6, composition of current liabilities and non-current liabilities and retirement benefit are presented below. So they gave us current liabilities, trade payables, interest payables, taxation, and non-current liabilities, deferred consideration, and that's 58. The liability is now 58 now. So that means there will be an interest expense of it. Liability for the purchase of PPE 288, loans repayable, provisions for deferred tax, retirement benefits. And they also give us movement in retirement benefit. And now we are asked to prepare Breakthrough Group consolidated statement of cash flows. Okay. And this is what we have. So again, you see how lengthy the question is, a lot of details. The same principles apply, the same approach, just capture the movement in position. If you're able to capture your movement in position, you will have done yourself a great deal. So if I go to my position statement, because I have so many details here from the notes to the account. So the first movement here is that of PPE from this to this. And knowing fully well that movements in PPE usually arise from addition, disposal, depreciation, and maybe revaluation or impairment. Those are what causes my movement. And I know from my additional information, from all this information they give us here, this one, note 1 has nothing to do with PPE because it's on goodwill. This one gave me, they said they did not dispose goodwill. They did not dispose assets, but there was depreciation of 120. So that's noted. It was established that there was no actual gains or loss in the year. And this one tells me about, it has nothing to do with PP. So the only one that has something to do with PP is just this note 2, that talked about my depreciation. And I can remember in note 5, we bought a subsidiary whose plant is also 140. So that would have also been included in my PP. So I just do my movement in PP between 2010 and 2630. And that will get me my additions or my acquisitions of PP. And that's what I did first. My movement in my PP. My opening balance was the opening balance there. My subsidiary, this 140 I told you about in this note 5, since I acquired the subsidiary, so 140. Then depreciation, they told me about depreciation of 120 in that note. And there was impairment loss, which is a revaluation deficit of 190. This is that in these notes. Inside this OCI, there was impairment loss on PP against evaluation surplus of 190. So this is a evaluation deficit of 190. So I net this one off. Impairment loss. So, and that's the movement. So I expect my closing balance to be this 1840, but my closing balance was this. It was 2630. My closing balance was actually 2630. So it increased by 790. It increased by 790, which would be an outflow. My statement of cash flows under investing activities. So I'm done with the first item, the first movement. So the second movement is in my goodwill, which moved from 50,000 to 60,000. So what is causing this movement? But first thing, you know that the way this 50 will have been calculated earlier on will have been the subsidiary that I acquired, this guy in note 5, that I paid 200 million for. I paid 200 million cash. Why the other 50 is different? I'm not paying that now. So the cash flow here, the cash impact here is just this 200. And that's the only thing I captured there. The asset I acquired, there was no cash there. And that's that 200. This would be an outflow. Then for the goodwill, the way goodwill is determined is my purchase consideration plus my deferred consideration, which is the 50, plus value of NCI. Since I acquired 70% in that subsidiary, meaning NCI is 30%. So it will be 30% times the net assets acquired, which is 96. And this is in this note 5. Oh. This is the subsidiary I acquired. You see, this is the 320, the asset that I acquired. I paid 200. I will pay 50 in the future, like that. So that's all that is happening here. So 200, I paid 200, 50 deferred, value of NCI, so 346. I compare with the net asset acquired, and I'm having 26. And when did I acquire that subsidiary in note 5? In 2022. But how much? It was 50. That was the goodwill in 2022. So what's happening? So I look at the movements that the opening goodwill was 50. The subsidiary I acquired during the year brought in a goodwill of 26. So my goodwill should be 76, but my goodwill was actually 60. So why did it decrease? It's because of impairment. So there's an impairment of goodwill. So this impairment of goodwill is a non-cash item, and since I'm using indirect method, I'll need to add back. I will add it back. Add it back. So after the goodwill, the next item is investment in associates. So it came down from 580 to 540. So, and movements in this one, it will just be this 580, the opening. If there is any share of profits, I can see share of profits in associates here. There's 60. You also have a share of tax, included in tax from associate is 20. He has a share of tax, so I'll take away 20. Also, he has a foreign exchange difference of 10 of associates. I'll take this away. Then I will get the balance and compare it with the balance I have. And I would have dividend received as balance. So investments in associates, the opening was 580. Share of profit, 60. His own share of tax, 20. Exchange difference, 10. Then you have my closing balance, expected. But my actual closing balance in the statement of financial position was 540. The balance is dividend received from associates, which should be an inflow in investing activities. To be an inflow in investing activities. The next item is inventory. Opening, closing, receivables, opening, closing. I'm going to ignore cash because that's what I'm working towards. I'm working towards my cash. So for the inventory, I want to check if the subsidiary has inventory. Yes, it does. It has inventory of 180. So I will consider it in my movements. So inventory opening, subsidiary, expected closing on 340. So our closing was 13. So there's a decrease in inventory. Decrease in inventory is an inflow. It's like we are selling inventory. I did movement in receivables too. I did movement in receivables, opening, closing. This one increased, outflow. Then I'm move on to the next item, which is share capital. This one increased from 170 to 200. Share premium from 30 to 60. Reserve came down from 290 to 110. That was because of that revaluation deficit. Then retained earnings, we look at the difference between these two should be profit, but since they pay dividend and all of that, that would also be a cause of movement. So let's look at all the movements in those items. First, my share capital, the opening 70, the closing 200. There's an increase. That will be an inflow. The same thing for share premium. Opening 300. My closing 60. There's an increase. That will be, yeah. For the retained earnings, I can use my retained earnings to get my balance. So they told me that they paid dividend to water side. Since I'm in retained earnings, I want to use that to get movement in these retained earnings would explain dividends. And they told me that they pay dividend, that they paid a dividend of 800 million to Waterside, which is a subsidiary. So what they are doing here is they invested in a subsidiary. So included in dividend paid during the year was 800 million. So where is the dividend paid? So in the statement of changes in equity, so there was a dividend paid of 892. So out of these 892 dividend paid was they did an investment in a company. So that would be an investing activities. Why the remaining 92 will be treated as financing, which is the dividend that was paid. So this 892, they said included in it was investment in Waterside. So the balance is the remaining 92 would come in as normal dividend paid to shareholders. Then after retained earnings, the next item is NCI. So I will do my opening NCI 90 is it will get its own share of profits, which is 50 to NCI. And if there's any expected closing, we'll compare with the closing, then we'll be done. And also there is value of NCI because NCI has a 30% in this Dandy. It has 30% in Dandy. So let me show you the movement there. So NCI opening was 90. It has 30% in our subsidiary, which is 96. Then his share of profits is 50, right? So his expected closing balance is 236, but the closing balance was 120. So the difference, the decrease is always dividend paid to NCI. That's always the difference. Is always dividend paid to NCI that will come in as financing activities. Then, after NCI is non-current liabilities and current liabilities, and that will be all. So, but they gave us the breakdown of non-current and current here. They give us breakdown here, non-current and current. So, the first one is deferred consideration. It increased by 58, but we already captured the increase. We already captured 50 when we were doing goodwill value. 50 is non-cash. The remaining 8 that is there is interest as a result of unwinding of discounts also, which is also a non-cash item. Then liability for purchase of assets. So there is 288, which is this one will be an inflow because we collected it to buy an asset. Collected this to buy an asset. 288. Loan repayable, it increased to also be an inflow. For tax, you treat deferred and current tax together. So I will look at the opening tax, this 50 plus 370, the current tax. I will then compare that with, I'll compare that with what I have in P&L, my tax that was paid for the year, including the tax that was paid for the year. I will remove that of associate because that has been dealt in associates. Then I'll compare it with the closing, and that will deal with that. Then retirement benefits plans. So This movement here, what was happening in between will be most likely your current service cost. Okay, yeah, they give us movement in retirement benefits here, and the only cash item here is the contribution paid to retirement benefit scheme of 14,000. These current and past service costs are usually non-cash, so there's really nothing much you can do to that. So for the liabilities, first, the current and past service cost of 26 are non-cash, so there's nothing we can do to that. The contribution paid, yes, that one is an outflow coming as operating. Then the trade payables under current, so just compare opening and closing together. So it's increased by 282 inflow. Then the interest payable under current liabilities, the opening was 90. There was an interest expense in P&L. There was an interest expense in P&L of 80, yeah. So there's this 80 I'm dealing with in the movement. So I expect my interest payable to be 170, but the closing balance was 100, plus this interest on deferred consideration. The remaining 8 is an interest payable as well. I just added it here. So making 108. So there's a decrease in interest payable. So this is the interest paid in that interest payable of 62. And for the non-current liabilities, the only there is liabilities that I collected. I collected loan to buy assets, so that's an inflow, and there's a loan that we collected. So the opening was 1.1, the closing 1.2, so it increased by 132 inflow as well. And I've really captured all my movements. So you need to sit down, take your time, and look at how I'm looking at all the movements here. I didn't waste my time. I didn't look at, they have a lot of details that I might not interpret. No, I didn't distract myself. I just focused on the movement. My PP, I looked at the beginning, what's causing the movement. I captured, and all the relevant movements, I was told. They told me everything in the question. The same thing for this goodwill. Just I need to be very careful here. Because for the goodwill, first I identified the relevant cash flow, which is the payment I made to that subsidiary. Then, apparently, this is not the only subsidiary I have. I have some other subsidiary. That's why I'm having this in the account existing, 50. But it changed to 60. So I looked at the movement in goodwill. I did opening goodwill for the year, expected closing. I got an impairment of goodwill. I did the same thing for associate. I picked it one after the other. If that's the only thing you do in this question, you will have gotten close to 15 over 20. Because your statement of cash flows, there's no reason why you should not do it, because as soon as you're able to do the movements, you are done with the question. Any question on statement of cash flows, any question. As soon as you have done your movements, then all you just need to do is just to plug in, because you are just copying and pasting at the end of the day. So since they ask you for indirect method, so you should start from operating profits. But for my P&L, I don't have operating profits. What I have is PBT of 1380. So I'll look at this, my share of profit. This one, I've already dealt with this, so I need to deduct this. my interest expense, this should not be treated here. In fact, just add it back because I'm working back to operating profit. So just add back this 80, along with the fact that it should be treated in financing. And I've already gotten the cash elements in financing. My distribution and admin, I've already gotten all the non-cash elements here, which is that depreciation that they gave me. I worked out impairment of goodwill, and there is impairment of assets during the year. Those 3 items. Then in my cost of sales and revenue, those ones, inventory, payables, receivables, those will be the adjustment to changes in working capital. So, which I've already done all the movements already. So, for my operating activities, I added back this interest expense just to work back to operating profit. Then I did adjustment for non-cash items. This is my share of profits, is a non-cash. They have added it before I deducted it. Depreciation of 120, they have deducted it, I added it. Impairment of goodwill of 16,000. So I'll just add it back. Then, what about impairment of PPE? Okay, so since that didn't go to P&L, it went to OCI. So that's why it's not in admin, so I won't adjust it here. Then don't forget that current and past service costs. They are also treated in P&L and they are non-cash. So I will add them back. So ultimately, if I accumulate all of this together, I will get 102,000. Then I did my changes in working capital. Inventory decreased, is an inflow. Receivables increased, that's an outflow. Payables increased, that's an inflow. So if I accumulate the 3, I have 162. So if I add all this together, it gives me 1724. Then don't forget the contribution that we paid on that retirement benefits outflow. Then I deal with my tax that we worked in workings 13 outflow as well. So I get my net cash inflows from operating activities. Then for my investing activities, which is the asset part, for the PP, we already identified 790 as the asset that we bought. If you remember, in my work, that was the first thing I did in workings 5, this 790. But later, which is an outflow, but they told me that I also borrowed money to buy the assets, liabilities for acquisition of 288. So that means out of this acquisition, I borrowed 288. So my outflow is actually 502. Then the subsidiary I bought, that Dandy, I paid 200. Then from investments in associates, we got a balance of 70 as dividend received from associates. Then the subsidiary, the guy I invested it in Waterside, 800 as an outflow. So I have a balance of 1432. Then for my financing, my share capital and share premium first, I got inflow there. And remember the interest paid, the outflow, the interest actually paid that we got. Then the loan payable, then the dividend paid to NCI that we got as balance in NCI workings. Then the balance of the dividend paid of 892, we invested 800 in Waterside and the remaining was paid to shareholders, 92. Then the balance net cash outflow from financing activities. Then reconciliation of cash and cash equivalents. So the opening cash and cash equivalents, this cash and cash equivalent during the year, this is the balance for operating, financing, investing, and financing. So it gives us 180. Then the opening cash and cash equivalent from the balance sheet, statement of financial position was 280, and the closing is 100, which is confirmed from the statement of financial position, the cash and cash equivalents. The opening was 280, the closing is 100. So what I would advise you to do is, if you can dedicate today to revise this and move on again, go and study these movements, how we do it. If you're able to finish revising it, you can get back to me. I'll send you another past question on statement of cash flow, consolidated statement of cash flows, that you can also practice yourself applying this. But first, try and solve this yourself. Sit down, solve it. Make sure you can actually capture the movements in the light of these questions that they gave us here. Yes, the note is plenty, but I mean, the key things are clear there. Like when I got to this guy, for example, I this deferred consideration, I know I've dealt with the 50. The remaining 8 is interest payable. You see that I added it to this 100 when I was doing movement in interest. This liability, I know, is an inflow. It increased, so I net it off against that asset I bought since it was collected to buy assets. This increase, I dealt with it as inflow. These provisions for deferred tax, I aggregated it with current tax to get my tax paid for the year. I mean, it's the same thing. Just try your best to look at it. So, any questions, please? Now, they can ask you for direct method. Direct method does not change anything. The methodology does not change. Nothing changes in direct method. It's the same thing. Just do your movement in position. Then you're done. So you can take your time to look at this question. This question is on direct method, but fortunately for this student, the examiner already gave them the movements. They have given us so I won't have to do this. It's because a lot of students don't understand that cash flow is based on movement. When they came out, they said, I've not seen something like this before. They gave us, I mean, I was surprised that who taught you people statement of cash flows? When they gave you the movements, I mean, there's no need for these workings that I did. I was just testing something for this. It's just an alternative way of getting a lot of things. I don't need, I will just go straight to because I've already given me the movement. So since I'm doing direct, for example, let me show you what I mean. For direct, I'm not working from profit. I'm starting from the beginning. So you look at it now, my revenue was 3.2. So should I put everything in cash flows? It depends, right? It depends if I've received everything. So for me to know whether I've received everything, I check if I have any receivables for the year, and I do. So they already gave me my receivables for the year is 36. That's my receivables for the year. So that means out of that 3.2, I haven't received 36. So all I just need to do is just 3.2 minus 36. So I've only received this one. I move to the next one, interest income. I will ignore this because this should be treated in finance, in investing. So I will ignore it. Gain on sales of plant, I will ignore it because it's a non-cash item. I move to cost of sales, 1920. This one is expense. Have I paid everything? No, I cannot have because there's inventory here. There's inventory here, there's payables. So inventory is non-cash. If it's increased, I will need to add it back. For the payables, If that one increased, I will need to remove it because I've not paid it. So, and I have inventory of 20. I have payables of 12. And all I just did for my cost of sales, I got my cash paid to supplier. I added the inventory. I deducted the payables. And this gives me my cash paid to suppliers. Inventory is non-cash. This one, I have not received this. Okay, I have not received this 12,000. These are payables, so I remove it. This inventory, inventory is deducted to get cost of sales and is non-cash, so I need to add it back. So the same thing for the staff remuneration, which is the next item after cost of sales, 480,000. If they didn't give me any notes in the additional information, but they gave me staff remuneration payable under account payable that I'm owing 4,000 out of 480. That means I've paid 476. And that's exactly what I did. Staff remuneration, I removed 4,000. So I've paid 476. Same thing for depreciation, I ignored that one. That is non-cash. Interest expense, I will go and treat that one in financing. Other expense also, I'll check if I'm owing any other expense. I go to my liabilities, but there's an other expense payable. But the reality is I'm not even owing because it decreased by 4/8, which means that I paid the whole of this year and I paid part of last year too. So the total I paid is this 304 plus 4/8, which is exactly what I did. I did 304 plus 4/8. Then my tax paid. So my tax expense was actually 120. But how much was I owing? I'm owing an income tax, a current tax of 8,000 because it increased. I'm also owing a deferred tax of 14,400. So I'm owing this and this out of 120. Out of this 120, I'm owing those two. So I just take them away since I've not paid them. So for my tax paid, so this is the current, this is the deferred. So I just removed what I'm still owing for the current and deferred. I have a balance. So this is my net cash flow from operating. For my investing, I deal with my interest income so that I won't forget. Is 20, but did I receive everything? I go to my assets. Yes, there was an interest receivable. So this one decreased by 200. That means I've received the whole of this year, and I'm also receiving part of last year because it decreased by 200. So this interest income will be 220,000 plus 200. And that is what I put under my interest income. Then the other ones for investing, I will deal with that under my plant, investment, and intangible assets. So my plants increased by 60, and perhaps they told me in the additional information that I sold a plant for 56 and I bought one for 40. And that is what I really do. So for my investing, I bought plants, outflow, and I sold, inflow. For my intangible assets, they told me that increased by 60. That's an acquisition. And they told me that intangible assets were acquired for cash. So 60. Then there was a prepayment that increased. So I treat that I treated that also as an outflow. But that's the only thing I've not touched in my asset part. So I just treated it in investing. It increased my 6,000 prepayment movements. So I cumulated everything together to get this. So there is this investment of 8,000. It increased from 48 to 56. I cannot ignore that. So that should be an outflow. But I saw that there was a gain on sale of investment. They made a mistake. This is actually a revaluation surplus, or it could be an investment that is valued at fair value through OCI, but this a revaluation of 8,000. And perhaps if you check the last item here, fair value reserve of 5.6, that's the balance here in this OCI after they remove the tax from this reserve of 8,000. That 5.6, that shows that this 8,000 is non-cash. I've dealt with the 2.4 years, so the remaining 5.6 was treated as a reserve, which is a non-cash item. So that's pretty much all that for investing. For financing, the interest expense of 16,000, I will check if I have any accrued interest. Yes, I have, of 800 this year. I will take that away from the 16,000 so that I can have what I paid. So there was increase in borrowings and there was dividend paid of 200. They told us that we paid a dividend of 200, which I can get as balancing figure in my retained earnings too, just like I taught you already. So all these other ones are similar, just the movements. Then you do your reconciliation of cash and cash equivalents, and that's it. So guys, let's go and take our time to revise this. For those of you that are doing case study, we'll meet at 3. But I mean, revise these things. Let me know if you have any challenges. If you can solve these yourselves, the consolidated, the single, understand it perfectly well. If you need more questions, you can request. I can send you one more question on consolidated. And you can restrict yourself to this. Just practice this. Do the movements. There's no shortcuts. Don't run and say you want to quickly do the statements. No, that's not how they mark. That's not how they mark your exams. They mark from your workings. So even if you don't eventually do the statement, but which you should, because as soon as you have done your movement, statement is just copying and pasting. Now that's all you're doing. But in this case where they already gave me the movement, so I can then go straight to my statement and start using the movement to deduct and all that. If they hadn't given me the movement, I would have really done all of this in my movement. So I will see you guys in our next class. In the next class, I will most likely be solving, I'll let you know, I'll be solving some questions on group accounts. Then we'll solve more questions on accounting standards. And we'll then use past questions to look at questions on sustainability reporting and some other areas. Then we'll be done for it for this day. But I would update you guys and let you know exactly what we need to do. So let's go and revise. I'll see you guys later. Any questions?
Okay, when are we meeting, sir?
What's it?
I said, when are we meeting next?
The worst case is next week, Sunday. That's the worst case. But if I have anything for you in between the time, I'll let you know. If I have anything for you in between, I would let you know. But it's sure that we're meeting next week, same time. But if there's anything in between, I would alert you.
Thank
All
you
right, guys.
very much, sir.
Yeah.
We are very
Later.
grateful. I'm very grateful, sir.
You're welcome. Bye.
Thank you, sir.